Well, a lot of people turn their home into a rental property over the years, but what if you go into the mortgage process with that intention right off the bat to buy a home, call it a primary residence, and then turn it into a rental? Is that a problem? Could it create issues with your mortgage if you aren't upfront? We'll ask Bill what he thinks coming up next. Welcome into the Smart Mortgage Show. I'm Ben George with Bill Litton, Regional President at Cross Country Mortgage. Find us online, smartmortgageshow.com. So, Bill, kind of posing the question here, because I know a lot of people have either taken their home and rented it out. I mean, rental properties are not an uncommon thing at all. But this idea of buying a home as a primary residence and then turning it into a rental, because I know there are differences in the mortgage process for a primary residence versus a rental. Could this create problems? So I want to kind of dive into this today because I think there are a lot of people that have considered this and maybe haven't even really thought about what potential consequences there could be.
Yeah, it's a very misunderstood area of lending for the consumer, and it's the number one most common form of mortgage fraud is occupancy fraud. So it's definitely a serious subject matter. People don't fully understand, so we try and guide them the best way possible so that they don't get in trouble, but also can save the most money possible, which is always the goal.
Yeah. So, the fraud, nobody wants to hear that word fraud being thrown around. I think, which is why that question comes up, because you don't want to put yourself in that position. But let's say for this scenario, Bill, I want to buy a home and, my intention is, okay, it's going to start off as my primary residence. I don't know in this situation, if I have a specific number in mind in terms of number of years, that we want to keep it primary before making it a rental. But you do know that you will intentionally make this a rental property in the near future. So how does this impact things if you're looking for a mortgage? And is this something you should avoid?
Yeah, so I don't think you should avoid it as long as you follow the right path. And it's really, we see a lot of people, their first investment property was maybe their first house that they bought. And when they moved up, instead of selling that house, they held on to it and converted it to a rental. So simple rule to keep in mind is when you buy the house, it says it right in the mortgage that you need to move into the house within 60 days. So that means you can't buy it as a primary and immediately rent it. That will definitely violate the terms of the mortgage. But second, you need to live there for at least 12 months, which isn't really that strict. So if you move in right away and you live there for 12 months, in the 13th month, technically you could get another mortgage for a primary residence, move to that new home, and the departed or the existing residence that you purchased over a year ago, you could convert that to a rental property. So that's a really great strategy as long as you follow a few simple rules.
So there's nothing wrong with me if I've been in my home now for 7 years and decide I'm going to move, but I want to keep my interest rate where it is because I did refinance back in 2021. I wouldn't have to be worrying about any potential risks, right? Because I lived there for a number of years.
Yeah, so great point, Ben, because the rate A was lower 7 years ago, and B, the rates on an investment property are higher. So now you've got lower rate in the market plus lower rate because a primary residence is roughly 1% lower in interest rate. So for those reasons, the investment value of the rental property is partially based on what the interest rate is. So to keep that low rate makes that property a more viable investment to hold on to. So absolutely, 7 years, you're way in the clear to do whatever you want there.
Okay. So let me get into a little bit of specifics in terms of, going into the home buying process and working with, Cross Country Mortgage to get a mortgage on a primary residence versus a rental. We don't have to go into it very deep, Bill, but I know there are some key differences, right?
There are, yeah. So on a primary residence, you can, if you're a first-time buyer, you can put down as little as 3%. And really, when you're talking about the mainstream of mortgages, you can't buy an investment property with an FHA loan, a VA loan, a USDA loan. Really, it's conventional lending, okay? And also non-QM, like our portfolio products that we use. So, but 3% down is a common first-time home buyer on a primary residence. On an investment property, it's a minimum of 15% down. But keep in mind, if you put 15% down, rate is going to be very high, closing costs are going to be increased, and you're going to have PMI, which is not going to be pretty. So preferably in the real world, we very rarely do 15% down on a rental property. 20% down is usually the threshold that we shoot for. 25% down is going to give the borrower much better terms. So 20% down doable and not, ugly terms. 15% down is ugly. 20% down is better. 25% down is optimal. So more money down for sure if purchasing as an investment from the onset.
Is it a pretty common strategy for people, Bill, to buy a home as a primary residence, live in it for a couple of years, and then make it a rental? Like instead of just going the rental route right from the beginning, just because it's on paper much more cost effective.
Yeah, we see it all the time. People that had the motivation to buy an investment property, buying the first house as a primary residence, living there for a year or more, and then converting that to an investment as they buy their next home. Very common, great strategy. And the other thing about that too is you could do that with a multi-unit property. So you could buy a multi-unit property with an FHA loan with as little as 3.5% down, or a conventional loan with 5% down. And this is a multi-unit, 4-unit up to 4-unit property. So now you got into that one with very little down. You live there for a year or more, and then you purchase, maybe your more long-term single family home after that.
I like that. That makes a lot of sense. All right. So finish it out with this, Bill. For anyone that maybe is thinking, okay, maybe I'll try to skirt the edges here and try to lock up the good rate and the lower closing costs with the primary residence, knowing it's going to be a rental. What could happen if you are found to have committed that fraud, Bill? What could be in store for you?
Yeah, well, one thing is the lender can call the note, right? So if you violate the terms of the mortgage, the lender can call it, and then if you did put 20% down or 25% down, or all that money could be in jeopardy. I highly recommend. It's not worth it. Occupancy fraud is a big problem. It is heavily scrutinized. So, we always say that, mortgage lending, you're kind of like an accountant. If you have a good accountant, they're finding ways to save you money, all legal, but they're knowledgeable and they'll use certain tools to do certain things. And mortgage lending is the same way. So we want to be creative and helpful and save you the most money. But there is a black and white line when it comes to occupancy that you just don't violate. And, we've seen a good amount of, in fact, there's a case, a very high profile public case of a Federal Reserve employee who recently did something that they probably shouldn't have done, or it's at least come into question. And it's based on occupancy fraud. So when I saw that, I thought to myself, man, that's one of the ones you really want to stay away from. That's bad news.
Yeah, it sounds like it. All right. Well, hopefully we discouraged anyone from maybe going there out there considering it, but hopefully, better yet, informed you about how this process works. So if you are thinking about turning your primary residence into a rental property, some good information here in the show. If you liked it, please subscribe to the channel. We'd appreciate that. It's very simple. Just hit the button. You'll be good to go. You'll be alerted when we have future videos. And if you have a question for Bill, you can always text the word LEND to 21,000 to begin the conversation with Cross Country Mortgage, but also drop a comment. We'll check those as well. If we see something to bring on the show, maybe for a future video, we'll do that. But we appreciate the support either way. Thanks for watching. We'll talk to you again soon.
Thanks so much.
This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.